the DSPX. It's the SPX Dispersion Index. We're going to take a look at that today and see what's going on in dispersion with options on the Brew. Let's get started. Yeah. What's up, boys? How are you?
What's going on there, Lex? How you doing?
I'm doing good. Today. I look like I rolled out of bed.
No, you actually look like, you're kind of more enthusiastic today.
Oh, okay. Okay, good. Well, that's because it's a new year or something like that. And, I'm on this new dry January. It's actually damp January, but.
That's it. You're not hungover.
There you go. What the heck? Mark and I aren't drinking wine together that much anymore.
Why are you doing that to yourself?
I know. I don't know. Just see if I can do it. It's only 3 days a week. For gosh sakes. You think you could do that? Oh, well. You think. It's pretty hard. There's wine bottles everywhere in my house. So, I look at them like, it looks pretty good. Anywho. All right, let's get busy. Mark, you're the man today. DSPX and dispersion. What are you seeing? Anything crazy?
I think we talked about this a little bit before when the SIBO launched this index. What was that? That was like last October or November or something like that.
Yep.
And it's interesting. So just, to set the table with what we're looking at here, this is the difference between component VIXs and index VIX, which is the VIX. So It's the VIX of all the S&P components net of the actual VIX, which is the index. And so how are implied volatilities in individual components comparing to the average of those components? And the greater the difference is there, the greater the variance from the index we're likely to see in terms of individual returns. People are predicting that in the future, individual stock performances are going to deviate more from the index rather than less, right? There are multiple ways to create an average. You're going to have an average that's like this, or you can have an average like this. What the rising DSPX is suggesting is that there's going to be more dispersion across, individual components. So we're entering a stock pickers market.
So just so we're clear, let me make sure I understand what you said. Bigger numbers in DSPX, which is this index that SIBO created, means that there's more volatility in the components relative to the VIX. Is that right? Did I get that right?
Correct, because if you average all of the components, that's the index, and that's what VIX is. But if you take all of the VIX, obviously, if you own the S&P 500 or you own the VIX, that's like got all the offsetting factors of being kind of a diversified basket. Whereas if you just look at all the individual components and sum them individually, they're showing actually more dispersion, or increasing dispersion, and it's forward looking. So it's like as the same way that the VIX is.
So, that makes sense. And then again, correct me if I'm wrong. Let's pretend that the components were all facing an earnings announcement. I'm assuming that DSPX would be a huge number because implied volatility would probably be pretty high in the components because of earnings, which would deviate much from what the S&P at large would show relative to VIX. Is that true too?
I can't tell if you stole Jason's question or if he also has another one. But
dang, did I just do that? Wait, I don't see that in the notes. Sorry.
I'm just raising my hand. I was going to actually ask something more practical, a follow-up question to that.
Okay, let him answer mine first, and then we'll answer your practical follow-up question because you're on dry January.
But yes, there's absolutely a lot of seasonality to this because of earnings, essentially. That earnings are one of the, or not one of the, they're 4 times a year, the event that creates the most single stock variance, right? That's when the concentration of news comes right from the horse's mouth. So yes, as going into earnings season, we absolutely expect to see more variance. That doesn't mean the S&P is going to go up or down or anything. It just means that the range of averages is going to be wider.
Okay. Got it. Okay, Jason, I'm sorry. Go ahead.
So I've got a question then. When, obviously this dispersion is not something new. Even though there wasn't an index before, the dispersion still existed, right?
Mm-hmm.
When it comes to measuring the index vol versus the dispersion vol, the DSPX.
Yep.
And let's say, like a large component of SPX, say like Apple has earnings, they miss or something, and Apple goes down 20% or something, much larger than its implied volatility.
Mm-hmm.
Obviously, that has a little bit of an impact on SPX, but typically, even though Apple is like 7% of SPX, and SPX feels it, it doesn't go down even close to the amount of Apple. When something like that happens, like a sell-off in one of the larger components happens,
Mm-hmm.
how does that money flow directly into the other equities in order to keep that index vol lower, or like how does that work?
Let me address your first point that I think is actually very interesting, that like, well, DSPX, or the dispersion index, has only been tracked very recently, kind of due to like the liquidity, there being enough liquidity due to like all the new options listed, like that tracking is new. But yes, this is a trade, I don't want to say as old as time, but that's existed for 20 plus years, right? That like tracking dispersion and components versus index is a very, common thing to do in the vol space and in the equity space, right? That's what keeps ETFs in line. It's kind of the same concept there. But I don't know if I totally understand the question about what happens with the individual components in terms of like the money flows. So like, I think practically what we'd see in DSPX is like, if Apple has, Apple's down 10% because Tim Cook's retiring or whatever they announce at their like earnings event, then what's going to happen to Apple vol? Because it's like the Apple VIX against the SPX VIX. So like if Apple, like maybe that increases vol, but maybe it doesn't, right? Like maybe it actually comes in because the earnings announcement is out. And so I think that's kind of where that seasonality comes in, is because, as those earnings inflated values come out of the market, the dispersion is going to get tighter because we're expecting less individual name variance.
Mm-hmm. Does that make sense, Jason?
A little bit, yeah. If usually when there's like an earnings report, particularly a negative one, the first thing that I see is usually vol expands in the farther, in the longer tenors.
Yep.
And I guess DSPX is only 30 days, like VIX, so we're comparing apples to apples.
Yep. And that's a very good point, actually, right? That like, this is only 30 days.
Right.
But like I could imagine like you could have a DSPX that was based on, the longer term options. So yeah, that is kind of interesting. But agreed. I think the short term of the earnings curve gets crushed if there's systemic risk or new risk factors that are introduced because of that. Then yeah, we'd also see play in back month vols too, for sure.
Okay, I'm going to ask the really dumb question. What is the use case of this for a retail trader, do you think? How can we retailers use this product or use this index to make some trading decisions? Or maybe the answer is you can't. Too bad for you. Any thoughts around that?
I think it's a lot like, I'd say it's more like it's useful as an indicator rather than a tradable product.
Yep.
So I think the SIBO has plans to launch a futures around this. They maybe even options on those futures. But ultimately right now, or effectively right now, it's only just an index. So you can only use it as a barometer of what might be going on in the market.
Right.
And so obviously we talked about a little bit about the cyclicality, and that's an important thing to know when you're measuring or tracking an indicator is, we're going into earnings season and this is rising. Like that's kind of expected, right? Like that doesn't mean just go out and smash component vol and buy index vol. But I think it does give a little bit of an indication that like, if you are putting on, say, short earnings trades or whatnot, then maybe there's some cheap index hedges you could get out of that. And that as that gap rises, maybe that opens the possibility for a spread trade, or maybe it just encourages you to tighten up risk management a little bit in individual names because we're expecting more variance. So like I'd say that depends on strategy, but it's an indicator of maybe components are going to be moving more. Index vol might be cheap.
Yeah, so I'm glad you said that, because here's where I'm getting here's my angle on it. If there, and I don't know what the angle is yet, but if there's a way that when DSPX is high, it can be a leading indicator of some kind, meaning that it might even foreshadow that a move is coming, or it might be the opposite too. You know, I'm not sure yet. I got to think about it, but you know, higher DSPX, you know, that's because components are very volatile, or much more volatile than SPX via component. Is that a leading indicator of volatile times coming, or is it the opposite? See what I mean?
I think to the extent that you believe the VIX is a good forward indicator, it probably goes along those same lines too.
Yeah.
And increasingly, we're seeing that VIX is a very good leading indicator. Like VIX is very well priced. We've talked about that a couple of times, right? So my suspicion is that the top components of this that make up a lot of the SPX are also fairly well priced. So I suspect, higher DSPX probably means, you know, watch out for bigger moves in your NVIDIAs, Apples, whatever.
And you say it's weighted heavily with Apple and the bigger components, right? This DSPX, just by
same as SPX, exactly.
Yeah. Okay. All right. Good.
Is there some place or somewhere where I can see perhaps maybe like a DSPX skew that I can compare to like a VIX skew, or is that something that has yet to be explored?
So they don't have options listed on it yet. I don't even believe they have the futures listed.
Well, I mean, if they're using the volatilities of the components, could they, you know, perhaps with the x-axis being deltas instead of, you know, strikes, could they make like a skew curve on DSPX?
They could do that, right, Mark? They've done it in the past for other things where they extrapolate what the values would be going backwards, right, based on underlying stock price and all that kind of good stuff. So it's definitely doable. Whether they do it or not is a different story.
Well, but it's a VIX calculation, which already does take into account a strip of options.
Yeah, that's true. That's a good point.
Right. But what I guess I'm saying is, even though DSPX is like a VIX calculation, you can, I guess, look at the underlying SPX options and see skew. Is there some kind of like breakdown by delta as the x-axis of what DSPX skew would look like? Does that make sense? Do I not make sense?
No, you make sense. I mean, sort of.
Okay.
I mean, as much sense as you can make.
Well,
wouldn't that just be like Apple? That would be either the components. Those would be the components used, though.
Yeah.
That's me just placing. Don't get me wrong. That's just me placing trades in VIX right now. I'm not. Nothing to see here, officer. Move along.
But like to see, like you can see a skew in VIX options, like VIX option ball is 100 or whatever it is, and upside call, like the 40 calls in VIX have an implied vol of 110, and the 5 delta puts have an implied vol of 140 or whatever. I don't know. I don't trade enough VIX to have that.
Well, right. I'm not asking about that. I'm asking more about like how SPX has a skew. VIX does reflect that skew a little bit when you kind of take at the money vol versus VIX. Is there something like the underlying of all of the components that where you can kind of see the skew of the components, like kind of aggregated together?
Would that be like comparing the at the money vol weighted by all the components to what DSPX is, similar to what SPX at the money vol is compared to VIX?
I guess something like that, but you can do it, across all the deltas.
Yeah.
Yeah. I think I see what I don't believe that exists, but I think I understand what you're saying in that, like, could you
write it down, maybe, future dashboard.
Be sure to copyright that before the SIBO does. You're guaranteed to lose in court against them. And even if you have a better product, they'll still probably beat you in court.
They'll they have more money. They will beat me. And look at this. Lex is going crazy.
What is that noise in the background? It says there's an incessant dinging sound. By the way, maybe for another show, I'm just firing out iron butterflies like mad. My new favorite spread.
Last time.
Yeah. Anyway,
why do you do them iron?
You know what? I don't. That's a good question. I just I like having two sides. It makes me feel like I can roll them easier, you know, if I need to. The put side versus the call side. You never know.
There might be something to that.
Yes, right?
Well, it's like I always like doing, even if I'm bullish on my broken wing butterflies or whatever, I always like doing them on the put side because it screws up put call ratios.
Yeah. No,
my 20 lots or whatever. But
and we're going to talk about this on another show, but the nature of an iron butterfly, it doesn't go anywhere until toward the end of the day. I'm talking zero DTs, of course. It just sits there no matter where the stock price is. It's like unbelievable. These things don't go anywhere.
Yeah, it's unless you make it off center.
Yeah, well, I lean it in the direction that Volland tells me I should. Did you hear that plug? You hear that?
I did. Where's your ding?
Ding. That's good. Okay, let's get back to dispersion. Sorry, I digress. Mark, if they is it in your estimation or your opinion that SIBO is going to actually list this product and have it tradable, put options on it, have futures? You mentioned futures already. So is this going to be like another SIBO proprietary, do you think?
I think that's their objective, yeah. I think there's some we're really getting into the weeds about like product creation specs and whatnot, but I think there are some additional complexities with this. They also have to get specific exemptions about it being not a securities future and whatnot. But like, I think ultimately, and like, there's the logistics of also finding a community that's going to be able to like effectively trade and hedge this.
Right.
But I think that is the plan eventually.
Okay. Will this be on your front burner?
I like it as a market indicator, right? Like I don't trade a lot of VIX options per se, but I pay a lot of attention to what the VIX is doing.
Sure. Yeah, I agree with you. I trade a lot of SPX stuff, and while we're there, Jason, you guys both probably know this. What would you say normal VIX is? Not too warm, not too cold, not too hot, not too cold, whatever the saying is. Is that around 13, 12 thereabouts, or is it a bigger number? Normal,
Depends on what realized volatility is at that time.
Well, yeah, but we have a VIX number that travels that people don't pay attention to, the realized versus that, VIX number, right?
Okay, then I would say 14 to 16.
Okay, fair enough. That's what I was looking for. Mark, anything?
I'd probably go a little lower.
I was gonna say 12, 14.
Yeah.
Are you there,
16
Mark?
is the long-term average.
Is it?
Like over the course of whatever, right? 15,
but what's the long-term median?
Ooh.
I bet you the long-term median is closer to like 11 or 12.
Probably.
Yeah. I just feel like 17 VIX, which is it's 17 and change for or 17 vol in the front months here in SPX seems, and I know it's a 30-day calculation for the other thing, but seems a little higher. I mean, than
SPX doesn't move 1% a day. It will move 1% on days, but it doesn't move 1% every day.
That's right. So
that's a choppy market. If we're like, think back to a year ago or 18 months ago when the VIX or when the markets were moving 1% a day, like everyone felt like they were battle worn by the end of 6.5 hours of trading, right? Like 1% consecutive days are, that's a tough grinding market.
Yeah, I agree. What do you think jump risk is volatility wise in SPX? Do you know what I mean by as
6.
Close to open? Yeah, that's actually a pretty good guess. Yeah,
I didn't actually hear what you said. What was your guess?
He said 6.
Oh, I actually was just throwing numbers out there. He's like, what is jump risk? I'm like, and my first thought is, what are the units? What are we talking about? Are we talking about?
It's IV terms. What's the implied volatility of jump risk for SPX?
Oh, I see what you're saying.
No, but you're right. You're pretty close, believe it or not. SPX doesn't have a huge jump risk component to it. So, when we see markets SPX open up plus or minus $20, That's not a big number, right?
No.
Typically, what I use for jump
2008.
risk.
What's that?
Yes. Sorry. What I use for jump risk is the 0 DTE and 1 DTE differences in straddle prices at the open.
Yep.
I think today we open like typically at like a $19 SPX 0 DTE straddle cost.
Mm-hmm.
And then I think like the 1 day, I think is like, typically it's like, 26 or so. So yeah, actually my throwing out my random number 6 is probably pretty close. You're right.
Yeah.
I actually think it's very close. Like you're sort of asking like a VAR like calculation question, right? Like in 99.9% of or 99% of scenarios, what's your max loss on this? Like, and I'd probably say that I think IB calculates. Yeah, I have a very SPX heavy portfolio, and like I think it calculates it even less than that.
Yeah. So does that that could mean that for these 0 DTEs, you're better off putting your IC iron condor on at the end of day 1 or day 0 for day 1 coming up tomorrow, because the jump risk isn't great.
Well, you've got to look at Volland, because Volland usually gives you a hint.
Is this a layup for you or what?
It was a layup.
I couldn't wait for you to figure this out. Jeez. Do I have to give you a notepad?
The next day, you can see if the bias is going to be up or down. Either using the all expiration Vanna right now, because dealer Vega is very high compared to its average, or you can use the next day's charm, which will show you if it'll have a bullish bias or a range bound bias.
Yep. Okay. Good. We're gonna have a peek at that maybe next week. What do you think?
Sounds good.
Yeah. Good.
Although we were talking about this last week, right? That like the overnight session feels underpriced. I think Jason and I both agree that the overnight session feels underpriced. Nothing more than feels, at least on my side. But like I think I'd rather be short 9 a.m. to 3 p.m. or 9 a.m. to 3:30 than 6 to 6.
6 the previous night, p.m. to 6
p.m. to 6 a.m. or whatever.
Really interesting. I don't like the space of news occurrence that could cause markets to move, and I have no control over the interim. So that's the jump part of it, right?
Now, like if you're trading SPX, like you've got like 30 minutes of jump risk between the two sessions.
That's true.
That's it. Not true. Even, or maybe it's only 15 minutes.
Yeah, that's a good point. Yeah, I've been experimenting though, so I'm with this overnight thing. It seems like it's priced high. So if it's priced high, I like to sell it. Just saying.
I'll take the other side of that.
Okay.
Ooh.
Right.
So can we do some OTC trades here, Lex?
So you're gonna do my short.
I don't even charge you SIBO fees.
You're gonna do my short iron condors overnight. I love that.
Yeah, I'll take the other side.
Okay, I like it.
Wait, hold on. I'm gonna write down this bet. This is a
hey, listen, I'm experimenting right now.
A Phillips swaption.
Yeah. Another phenomenon, we got to go after this, but another phenomenon I'm noticing, like the period from 2:50 p.m. to 3 o'clock when they mark the index, the SPX, right? That 10 minutes is insanely, the market of the cash price of the SPX moves so much in those last few minutes. And in the last 3 minutes, it's insane. I've seen $10 moves in SPX print in 3 minutes.
Yeah,
what's going on?
Not
everyone's managing baskets
there. A lot of times
there.
we see it, man.
It's crazy. I used to sell that period. I'm like, why am I selling this? I got to be buying this stuff.
Yeah, you buy at the end of the day.
Oh yeah, it's insane. So, all right, Mark, you froze up. Are you there? Move your head. Move your eyebrows. I can't.
No, you guys are coming.
You've been frozen for a while.
You've been frozen for a while.
Yeah, but it's okay. It's
all right. Well, you were able to talk though.
It helps us listen.
That's more important. All right, good show, guys. DSPX. I like this. I'm going to pay attention. You guys have a good weekend. And next week, I want to look a little bit about this jump risk with Volland and all that kind of good stuff as well, if we can do that.
All right.
Cool.
Sounds good.
Mark, You behave and don't drink anything funny this weekend.
I was gonna say, enjoy your 4 days of dampness.
I'm gonna get moist from today through Sunday. I'm doing 3 off, 4 on. Just saying.
That's about right. Weekend starts on Thursday.
Yeah, always. Why wouldn't it? Yep.
Yeah, my weekend starts after this show.
I've been watching Suits, that show from the mid 2000s, which I've never saw, and I'm enthralled. I can't get enough of it. And I'm like, I would have been really good at being a lawyer. All they do is drink whiskey in their office late at night or after hours. I'm like, this is awesome. Every day, every show, they're drinking whiskey.
Yeah, but if you're a trader, you get to go to series at like 1 o'clock or 3 o'clock. Lawyers have to wait until like 8 or 9.
That's a good point. And you work a lot less hard in being a trader than you do being a lawyer.
Oh, yeah. Half the hours.
Half the hours. That's right. Half the hours, twice the pay. All right, boys. You guys have a good weekend. I'll see you next week. All right.
All right. Happy trading.
Happy trading.